Life insurance can double your money every 7 to 10 years. In this episode, I am going to address life insurance done right does not cost money. How? Watch, I'm going to blow you away. So I'm Doug Andrew, and I've been a financial strategist for more than 4.5 decades, and I've helped thousands of people use life insurance for living benefits as a superior dream solution, so to speak, for all kinds of financial goals, be it retirement planning, college funding for their children, working capital for business, real estate management, and so forth. A lot of people do not realize that you can structure a life insurance contract to where it does not cost money, it makes money. See, many times when people say, where is the best place, Doug, where I could sock away some money and be able to achieve a safe rate of return that is tax advantaged? And I would say, well, it's not where you maybe think, like an IRA or 401k. No, it's in a max-funded indexed universal life insurance policy because I'm able to self-insure to where the actual cost of the insurance goes down as I get older until it no longer costs me anything. So let me simplify this for you. I'm going to share with you what a 60-year-old could do, and it doesn't matter if you're 30, 40, 50, 70. This applies to everybody. But I'm going to use an example right now to show you how you can self-insure in less than 15 years to where you're basically not paying for your life insurance. It's being paid for with a minuscule amount of interest that would otherwise go out the window in unnecessary income tax that most people shell out without even knowing it on their traditional investments. So a 60-year-old, we'll use a male for an example because life expectancy is a little bit better for a female at that age. A 60-year-old male who wants to use a life insurance policy more for living benefits, for the tax-free accumulation and tax-free access, and that's provided under two sections of the Internal Revenue Code, Section 72E and 7702. And then when you ultimately die, life insurance blossoms and transfers out totally income tax-free under Section 101A. If that's your objective, what you're trying to do is the opposite of what most people do when they purchase life insurance. See, most people think of it as death insurance. They want to get, let's say, this amount of insurance coverage for the least premium. What you're doing when you're using it primarily for living benefits is you're flipping that, okay? You're trying to get the least amount of insurance that the IRS will let you get away with under their tax citations, and you're trying to put in the most money as fast as the IRS allows, and it turns into a tax-free cash cow. So let me give you an example. A 60-year-old who wants to accumulate money totally tax-free, they have to take at least $1,250,000 of life insurance if they want to be allowed to invest, let's say, $500,000. Now, you don't have to put in $500,000, but let's say that's the most that you would like to put into that contract. The fastest you can put it in there is in 5 years. So let's say that a 60-year-old wants to reposition from IRAs and 401ks that are subject to tax and they want to convert to tax-free. Let's say a 60-year-old has money in banks and credit unions earning a pathetic 1% or less, and so they want to increase the rate of return. Let's say they have some real estate properties that they're tired of taking out the trash, fixing toilets, evicting tenants, and so they want to sell and they want to know what to do with the money out of their real estate. See, you can take money from any source that's underperforming or totally not performing at all and increase the liquidity, safety, and rate of return and the tax benefits by using a max-funded insurance policy. So let's say the 60-year-old wants to sock away $100,000 a year for 5 years, a total of $500,000. Now, they can do that in one fell swoop, but it wouldn't be tax-free when they access it. And so the IRS says you have to spread out the funding over at least 5 payments, 4 years in one day. If you pay the first $100,000 on the first day of the first year, The first day of the fifth year, which is actually 4 years and 1 day down the road, you can put in the last 100,000. So far, so good. So let's say you put in 100,000 a year for 5 years. That's 500,000. The 500,000 is what the IRS calls the GSP in the insurance industry, guideline single premium. For 500,000 to be able to accommodate that, a 60-year-old has to have about $1,250,000 of life insurance. That's under two tax citations called TEFRA and DEFRA. They're acronyms, okay, that were passed back in the 1980s. But here's the math. So I put in 100,000 a year for 5 years. And so now I'm 65 and I have my 500,000 in there. Now it's going to grow while we're putting it in, but let's just say I have 500,000. That 500,000 is netting because I am taking the least amount of insurance. I could buy way more life insurance than $1,250,000. That's not the objective. I want the least amount of insurance. Here's why. When you put in the money, every time you put in money, that can qualify as part of the death benefit. So when I finally have 500,000 in there, the actual life insurance that is at risk to the insurance company is no longer the $1,250,000. Yeah, that's what they would pay out if I died, but 500,000 of that is my own money if I want it to be. Well, that means they're only charging me for 750,000 of insurance 5 years later, even though I'm 5 years older. The cost of insurance is getting cheaper. 500,000 earning the rate of return I've been earning will double in 10 years, okay, to at least $1 million or $1.5 million. It has done that for many, many clients. So let's say when it doubles to $1 million, now the amount of insurance is only $250,000 they're charging me for. It's getting cheaper because the amount at risk is going down. The cost per thousand of insurance goes up as you get older, but the amount that I'm actually being charged for is going down because I'm replacing it with my own money inside the policy. Does that make sense? So, hello, if I have $1 million, that's going to double in 7 to 10 years to $2 million. Well, wait a minute. I have $2 million of cash, tax-free. The death benefit's only $1,250,000. There is no risk. In actuality, the insurance, as soon as the cash comes up to equal the insurance will grow with the cash and stay just a little bit ahead of it. That means that the cost of insurance is getting cheaper. I'm now self-insuring. It is my own money now. This is actually the cheapest way to buy term and invest the difference. But listen to this. So as I get older, the cost of insurance is getting cheaper. Have you ever seen a life insurance policy that gets cheaper as you get older? Well, it's probably because you haven't seen one designed like this. Now, before I share with you what this means and can mean for your brighter future, if this is resonating with you, click like, make a comment, share this with other people that need to learn this information. Please subscribe and click the little bell so you'll be notified every time I post a new financial answer to a in-depth question that is asked, 300 to 3,000 times a month. I don't want you to miss out. So what this means is if I earn a rate of return, which I have traditionally earned for 45 years, 8.2%, that means that the cost of insurance is getting cheaper as I get older. On the average, it uses about one of those percentage points, but the older I get, the cheaper it becomes. So for example, on some of mine, I have earned an average of 11% and I've netted 10% on the average. Now, in order to net 10% after tax in a tax-deferred IRA or 401k, in my tax bracket, 33% between federal and state tax, I'd have to be earning 15%. Now, very few investments earn 15%. If they do, it's for a short time period. It's pretty risky. I don't want the risk. But I'd have to earn 15% to be able to net 10 after tax. Does that make sense? If I have $1 million and if it was earning 15%, which most places where you put your money does not, that's $150,000. I pull out $150,000 and I pay tax of 50, a third on the 150. I'm only netting 10, right? Well, with the insurance contract, it's tax-free. I can earn 10% tax-free. I'm actually earning 11. What's the 1%? It's the cost of the insurance that the IRS says has to be there in order for it to be construed as a life insurance contract and be sheltered as tax-free in those sections of the Internal Revenue Code. But I just got through sharing with you that the insurance can get cheaper as you get older. Yep. See, I have policies that I've had for 30 years. So to be honest with you, if I earned 11% this year, I would net 10.95 because the amount of insurance is so negligible, and anything that goes to the cost of the insurance is money that would otherwise go out the window in taxes if I put my money where most Americans put their money. So guess who's paying for my life insurance? Uncle Sam. Now, indirectly, but I'm not paying for it. People say, whoa, this is incredible. How come I've never heard of this before? Well, yeah, you can redirect otherwise payable taxes to causes you support, but I'm not paying for the insurance. Nothing's free, but it's being paid for with a minuscule portion of money that would otherwise go out the window in unnecessary income tax. So let me ask you this question. So this portion that goes out, the cost of insurance, COI, is what it's called in the insurance industry. So when you structure an insurance policy primarily as a living benefit, pretty soon your cash value in less than 15 years, if you maximum fund it as fast as the IRS allows, in this example, in 5 years, my heavens, your cash now equals and exceeds the original death benefit. So now the death benefit just grows with your money. And that's why the rate of return gets better as you get older and the cost of insurance goes down. But a lot of times people go, but I don't need insurance. So why don't you choose the investment that is growing and generating the most? Can you agree that this outperforms all these other places where you used to have your money? Oh yeah, I don't need insurance. Okay, why don't you make me the beneficiary then? It's coming along for the ride. This is net. And people start going, oh, because sometimes they think insurance is a necessary evil. They think that once you have enough money, you don't need insurance anymore. Look at what it does instead of what it is. I ask audiences, men, women, what are some uses for baking soda? And usually the women will chime in, you can take odors out of the food in the refrigerator, okay? You can soak in the tub with it. It takes the pop out of a pot of beans, all kinds of uses. And then finally somebody goes, oh, it's good for baking. Yeah, life insurance is for life. Most people think of it as a necessary evil in case you die. So let me frame it this way. If I were your employer and I came to you and said, hey, we've had a great year this year. We have some good profits, and so we're going to offer some additional benefits to everybody here at the company. Free life insurance. How much would you like? Now, guess what answer I get 95% of the time? Oh, as much as I can get. Yeah. We don't object to the insurance benefit. We object to paying for it. If I can get it paid for with otherwise payable tax, I'll take as much as I can get if it doesn't cost me anything. So before I ask you that question, and I'm going to act like I was your employer when I ask you this question, I need to frame it first. So if this is intriguing you and you'd like to learn more, I would strongly recommend you claim your free copy of my most recent best-selling book, book number 11. This is flying off of our warehouse shelves. You don't need to pay $20, the retail price for this. I'll gift you a copy. Now, it's a 300-page book, but it's actually 2 books in one. This side is 300 pages, 14 chapters with all the charts and graphs and explanations. But if you want to learn by stories and examples, you flip the book over and you read this side. This is for the right brain thinkers. And this has 62 actual stories of how what I call the laser fund can be used for all kinds of financial goals. What is the laser fund? It's a max-funded indexed universal life insurance contract designed for living benefits like I've been talking about in this episode. So to claim your free copy, just go to laserfund, L-A-S-E-R fund.com. Contribute a nominal amount towards the shipping and handling. I'll pay for the rest and fire out a copy for you and you begin to learn how you can own your life insurance and be self-insured.